Teddy Keckstead from Forex Trading Unlocked, and we are here with a Forex market analysis for April 12th through the 16th. We just want to remind you with our disclaimer that this webinar is for illustrative and educational purposes only. Looks like we don't have any feedback, which is nice, so we can continue now. If you have not subscribed to already, please subscribe to our YouTube channel and also like it and pass it on to your fellow traders in the online trading community. We are also on Twitch as well, so YouTube and Twitch will always let you know when we are streaming if you are subscribed. All right, let's get into our live analysis here. We have the Forex-Trading-Unlocked.com website pulled up. We have the Euro US dollar pulled up. Let's go back to the dollar index for those of you that are just joining us. So the dollar index has been retreating since April has begun and the second quarter has started. We topped out the end of March with a higher move high. Unless we take out this 91.30 area here in the dollar index, this is only a corrective move to the downside before a bullish trend should re-emerge, at least right since we've been making higher move highs and higher move lows. We are only looking at the current downtrend in the dollar index as a corrective move. Let's check out the Euro US dollar here. So this market is also in a bear market. This is the biggest component in the dollar index. Now we had a buy signal here, a 3 inside up high probable Japanese candlestick pattern, which ended the end of March and sparked this corrective rally to the upside. The Euro US dollar has been making lower move lows and lower move highs. That is a bear trend. So right now we are viewing this as a corrective rally. Is it running out of gas? This is kind of the inflection point for the trend to continue lower for weakness. Since we have stability, or actually a calming in the 30-year interest rate market, as well as a stability in oil prices over the past week or so, meaning that it hasn't been trending aggressively higher anymore, let alone it's not selling off either, but it's setting a range. That will be something we need to watch. If oil starts to get another rally and if the 30-year treasury bonds start to fall apart again and pressure support, meaning higher interest rates, odds are it will be very, very unlikely that the Euro US dollar will be able to maintain strength against the dollar, especially with the new lockdown measures going on in Europe and everything that's going on there. We know that they're on quantitative easing number 100,000, who knows, whatever it is. It's not going to end there for a very long time. That story does not bode well for the Euro US dollar, at least in the short run. Should we get a big rally in the 30-year treasury bond market, meaning that rates would be going lower, and if there's definitely a sell-off in oil, that would relieve pressure on the European economy. Plus, remember, interest rates are a function of currency pricing. So with interest rates going up in the market, forget what the Fed is doing, that gives strength to the US dollar. So we're looking for this market to probably press through resistance and flirt with it a little bit more through today into tomorrow. But we have to watch these other markets, especially gold. And we'll get into that as we get more towards the markets that really matter with that. So British pound US dollar here, it did flirt with this new low right here. And it did make a lower move low. So here was a low, here was a lower move high, and we have over Friday and today's trade pierced a lower move low. So technically, the downward trend is still in place. So we are looking for either a rally above $1.3921 to confirm an upside breakout. Anything below there, we are still bearish, looking for the British pound US dollar to take out this $1.3667. Now, oil is definitely one of the reasons why this market is on pause and banging on support. Remember, the pound US dollar has been in a very aggressive bull trend versus the dollar for over a year. And almost a year to the date, it is reversing gears, at least for a correction. This is probably because oil has been on pause since the last 2 weeks. If oil gets a big rally that is strong for the pound US dollar, I would not fade that move. If all of a sudden you start seeing oil back above 64, 65 bucks a barrel, there is a very, very strong chance that the pound US dollar will be trading above this $39.21 area here. So be very cautious being a bear in this market. Keep your wrists definitely tight. And like I'm saying, anything above a 39.21, you do not want to be short, because you will be fighting an aggressive move to the upside. Remember, the long-term trend for the pound US dollar is bullish. Intermediate term, somewhat neutral, not bearish. Short term, obviously, hourly and daily leans towards the bearish. But it is very, very likely that if you get a rally in oil, and especially if you get a, at the same time, would actually get a rally in the 30-year Treasury bonds, that would help the pound US dollar continue to rally. Otherwise, we are looking for another test of support. We might bobble around a little bit before that happens, but we're not an aggressive bear here. But we are definitely not a buyer until we have a big surge in oil. That's what we're looking for. If we get a big rally in oil, all bets are off. We're looking for the big bull to come back. US dollar CHF. Now, is this because of gold or because of what's going on in the interest rate market? Well, the pause in interest rate markets over the past week and a half has definitely helped to have the aid in a sell-off with the US dollar Swiss. Now, you got to remember, this market's been trading to the upside since the beginning of the year, and the US dollar has been very strong because flight to quality areas have been fleeting. Remember, as the 30-year Treasury bond has been tanking, banging support, that means interest rates are going up. The bonds are usually a flight to quality, just like the 10-year notes are. Also, flight to quality is the Swiss franc and the Japanese yen, both of which are collapsing right now versus the dollar. Maybe a little bit extreme to say collapsing, but definitely the trend has been, for the past few months, maintained a bull for the dollar. This could be because of gold also. We'll get into that as we get towards the yen. So notice today we have not taken out the lower move low. We are coming off of a higher move high. Until we have a failure here at 92.20, we are not going to be a neutral or bearish this market, especially with high oil prices. Any continuation of the bull trend there, let alone a continuation of the bear trend in the 30-year Treasury bond, will have this market hammering new lows. Also, should gold start to fall back on support, it's having trouble holding this rally currently. If that falls back, it is very, very likely that you're going to see US dollar Swiss make a run for new highs and not for new lows. So we'll be watching today to see if we can spark a new low. Even if we do, I would say in the short term at best, it's neutral. I'd be very cautious trying to sell into these levels here. There's very, very, very good chance that we will get a bounce somewhere around here. Now let's go to the US dollar Japanese yen, since I mentioned that. As you can see, this market kind of looks like the Swiss, although it is not selling off as much, mostly because of the oil. Swiss don't produce oil, but one thing they do have is a lot of oil near them. When it comes to Japan, their ability for suppliers and stuff is a little bit more limited and controlled, so oil is definitely something with its rally and bull market that's going on is hurting the US dollar, or excuse me, is hurting the yen, so it's strong, the US dollar yen. Also, let's take a look at gold real quick, since I mentioned that. There is a very high correlation right now between, XAU, USD. Let's see if that works. There we go. All right, so this is like an upside down yen chart for the most part. If you look at where we bottomed here, this is where we topped out in the yen. What we have here is a corrective move higher. We made a higher move low barely after this lower move high, and we made this higher move high. Now, normally that would be indicative of a beginning of a bullish trend. We're not so bullish on that one, especially with the potential signal that's forming here right now. So we do have a high probable Japanese candlestick pattern that is forming. It's not done yet. This has to finish itself out with today's trade. Should this market end where it is now, or even lower, this would be a short-term sell signal. It would be a 3 inside down Japanese, high probable Japanese candlestick pattern. It's a very reliable sell pattern. This would be going with the trend normally this would be considered with the trend because this market's been making lower move lows and lower move highs. We could say that the current low right now is a lower move high after a lower move low. So we'll see what happens with the sell signal. It is kind of neutral. Should this market end where it's at right now or lower, and if you see the US dollar yen start to make a move towards the highs, turning around, reversing gears, then that means that we still have this synchronicity in the markets. Now, does gold and yen always trade in this type of relationship? No. They do right now because we have a very commodity-driven influence in the currency markets. So the US dollar obviously is kind of net neutral when it comes to most commodities, but something like Japan, they don't have very many resources. So any inflation in commodity pricing definitely impacts the yen and makes it weaker versus other currencies. We can look at it versus other ones out there. So in fact, why not do that? So British pound, JPY. Okay. Now, as you can see, the pound is sold off a little bit versus the yen, but overall, look at what kind of a bull that is. This is what I mean when we have this commodity-driven trade. Oil is so dominant for the British pound and so dominant for weakness for the Japanese yen that you can see from this rally here, this isn't a bull market. And like I said, gold looks like it's starting to have a sell signal. This right here is starting to look like a short-term corrective bounce setting a higher move low. This isn't a bull market. Higher move high, higher move low, higher move high, higher move swing low forming. If you see a rally continue in the British pound JPY, it is very likely that the US dollar JPY will continue to do so as well. So be very cautious trying to be a bear. If we've already hit targets that we didn't think we would hit until basically the end of this month or into next month. So now our upside targets, if we get a breach of a 111.06 up here, our upside target is around 113 to 114.20 in the US dollar yen. I know it sounds extreme, but this is a bull. So, and we have these are long-term trends that have begun over the course of the past few months, and unless we see deflation in much of the commodity sector, especially oil, and if we don't see a bounce in the Treasury bond market, it is going to be very, very hard pressed to be a bear against the dollar when it comes to a currency like the Japanese yen. So this is good for their exports. It's good for us as a buyer of Japanese goods. The only problem with it is that their goods will also still be getting more expensive. So where our dollar value goes up versus the yen, the pricing of goods goes up. It's pretty much a cancellation factor. And then once we have weakness in the dollar, we'll really get hit with inflation versus Japanese goods. So short term probably has some good things to help float the Japanese economy. Long term, this could be a rubber band effect that really, really has an impact on trade balances and the global economy as far as being able to maintain consumerism, which we know is definitely the driving factor of the U.S. economy and the way the world feeds off of the United States. So, breakout of 111.06, targeting 113 up to 114.20. Only a failure from here at 108.35 confirms new move lows after a higher move high. That would not necessarily make us bearish. That would just have us set up to be neutral to slightly bearish for a correction. Remember, this has been rallying since the beginning of the year. For us to have somewhat of a little correction is not out of the realm of possibilities. Right now, if we have a little neutral trade and we start to have a rally that fails, we could be setting up for a head and shoulders. So key support right here, like I said, is 108.35. We'll see also if this trend can hold up to the upside. So we get a failure here. Does that confirm a head and shoulders? Not necessarily yet, but it's coming close to a potential head and shoulders, which would be a sell pattern. That would most likely then have us going back down to this 107, probably to 106 half area on the extreme. So we'll see what happens. Like I said, if we get a big oil in rally and a sell-off in the 30-year Treasury bonds and the 10-year notes, do not fade any rally with the US dollar yen. And watch that pound over the yen too. If the pound is rallying to new highs against the yen, that probably, and that's confirming the commodity trade as well. Do not jump in front of that freight train. So look for waiting for definitely a really good sell signal should that occur. And right now, like I said, we're kind of looking for a buy signal, a little dip to buy and get us back in for this move. Australian dollar, US dollar. This one's a little choppy right now as the commodity trade has been starting to smooth out. We're waiting for a signal. We had a head and shoulders sell pattern that was triggered here, and now we made this lower move low here, and now it looks like we're basing. So we're have to key off of this major high here. Anything above 78.54 definitely confirms bullish momentum. Do not jump in front of that freight train. Key off of the high from last week here around 76.80. Above there, we will look for a nice little run up to challenge this 78.54 level. But we have to first get above that first. Any failure here in a test of 75.31, we're not looking for any really extended downside sell-off. Now, should oil all of a sudden get a really, really big sell-off, and gold, if it goes back to lows, remember we mentioned gold, how it's hitting the US dollar yen, where if the gold market starts to fall down and the oil market goes up, the yen will be falling more versus the dollar. The same would happen with Australian dollar, US dollar. It's a commodity-driven country. If there's any deflation that comes in to slow this current commodity rally, that would be bearish the Australian dollar, US dollar in the short run. Now, overall, this is a long-term bull versus the dollar, but since the end of February, we topped out. We've been making lower move lows and lower move highs, indicative of what? A bear trend. So until, like I said, we confirm a rally first above 76.80 and then a breach of 78.54, we are neutral to bearish the Australian dollar, US dollar. Now for the New Zealand dollar, US dollar, this is pretty wide too. This is basically mimicking the Australian dollar as far as the commodity trade. It's not as extreme. Are we looking for a rally? Not right now. It's been making lower move lows and lower move highs. That's a bearish trend. It's kind of neutral right now. That also, I think, is basically because of the commodity pause right now that we have going on with oil and gold, and as it's trying to make a decision as to whether the current moves are corrections or the beginnings of a new trend. So that's the big thing that we need to find out over the next couple sessions. If you look at, like I said here, this is a lower move low with a lower move high. If we start to continue to drift higher and get up to the 72, 71 area, that keeps us on the neutral band. I think range traders are going to have a field day probably over the next couple sessions. Swing traders, I think it's going to be a nightmare. I think you're going to have to take your profits fast or get ready to lock and load for a really, really long trade if you have a good signal. If you are bullish right here, I would say that do not stay long above 69 or below 69.44. Any failure from here obviously confirms new move lows after a lower move high and momentum to the downside. So follow the Australian dollar and the Japanese yen. It's that the commodity trade is influencing them, like I said, and continues to do so. Then you will probably see that mimic them as well to somewhat of a degree. All right, now let's go to the U.S. dollar, Canada. U.S. dollar Canada we have here. This has been an aggressive bear versus the dollar. And once again, this is commodity driven as well, especially with oil. Unless there's a big sell-off in oil, most likely this market's going to remain neutral to continuing its bearish trend. Key off of the $26.52 area, a rally above here extends this current upside correction versus the bear trend. Like I said, we are not bullish this market at all unless you were to see a huge, huge sell-off in oil. So considering that where oil is right now, hovering just below $60, we would need to have a break under $50 down to like around $45 to even begin to think of seeing this U.S. dollar Canada up around this $1.28 even to $1.29 even. This trend is strong. The Canada has been rallying against the dollar. In other words, the US dollar. Canada has been breaking in a bear market for over a year now, and it's definitely being compounded by, it started with COVID-19 and then it went into the oil trade. Especially with the relationships right now between the US and Canada being very strained, with the oil industry being one of the issues. It's going to be very choppy and tough here. I think range traders, you're going to have a field day over the next couple months with lots of opportunities where you're not going to get any radical swings unless you have a breakout in things such as oil, especially oil. Oil is the key to this market. So remember I mentioned the Treasury bond futures here. They're actually slightly lower. They're in a range trade. If they can continue to make new highs after this higher move low, then the dollar is probably going to fall under a little bit of pressure. Now remember, we also showed you the gold. I want to remind you about this one to take a look at. I keep doing this on the symbol. My fingers are not working today very well. Okay, XAU. So remember this one here. If our sell signal here does manifest, remember it's only 10:35 Chicago time. We have a lot of hours left in the day. This market could still make a new high yet today. So do not try and get in front of this signal. Wait until it occurs. We'll have another webinar later on to confirm this. This will be one of the indicators that helps to guide us with the directional trade for the US dollar, Japanese yen, as well as a couple other markets as well. So now let's go to the CL crude. So remember how I've been talking about crude. Crude right now is trading pretty much around where it was on Friday. If we get a rally above 62.37, this will start to make the pound rally versus the dollar. This will make the dollar rally against the yen. This will also make the US dollar Canada fall apart. Higher oil means bearish US dollar Canada. Higher oil means bullish British pound US dollar. Higher oil means lower US dollar Japanese yen. Remember those. This is very key. Now this 57.33 is a critical area. If we could fail here in the crude oil market sometime over the next few sessions, remember we've got the oil numbers on Wednesday, this will change gears. A failure from here should precipitate more selling pressure in the US dollar yen, meaning yen strength, okay? If you can also verify that if this market is collapsing here, check the pound over the over the Japanese yen, which then you should see that continue to start to slide as well. That would lock in the fact that the pound US dollar should sell off and US dollar Canada should sell off also. Then you would also have the US dollar yen selling off because the crude oil is going lower. So remember, there's an inverse relationship between those currencies. It'll be very interesting to watch. This is like the question of, does the dog wag the tail or does the tail wag the dog? So remember that the dollar index is in a corrective break right now. So should these other markets reverse gears and we get a breakout one way or another, this will either continue the dollar trend lower and this corrective move, may even be the beginning of a big bearish trend. Like if oil was to trend lower for the next, say, 2 months into summer and get back down to $45, $40 a barrel, even upper 30s, that would definitely precipitate a big sell-off in the dollar index, which would then give markets like the yen and the pound and the Canada lots of action. The euro-US dollar, however, this is more due to lockdowns. So we don't have any questions on the chat room. If you guys got anything about what we've been talking about, feel free to throw something out there as I'm winding down this webinar. So we'll be watching these markets over the next couple days, especially the 30-year, the 30-year oil and gold. They will give us our signals. Right now, we're coming off of the end. We had this buy signal in the euro. We've topped out. So for here, we don't have any reason to really push through resistance anymore unless there's a reason that there's a turn or weakness in the dollar. US dollar CHF, this is another one where, look at this, we're on that low. Remember, we're about to confirm new move. Let's see, we actually might have done it. The low here is 92.13, this is 92.12. Okay, so as we've been talking right now, we just confirmed a newer move low in the US dollar Swiss. Remember, this is just a corrective move right now. It looks very bearish. It's all red every single day except for what was on Friday, which was just a pause for the cause. Um, Profit taking could come in very quickly. Remember, if this is just a corrective move and these commodities and other markets go back to the way they were trending, meaning go lower, oil higher, interest rates higher, meaning bond prices lower, and Treasury note bonds prices lower, then that would mean that this is just the beginning of a buy setup in the U.S. dollar Swiss, and we're going to make a run for new highs. And also remember the British pound US dollar, key off of this market for oil. You know, that is the big thing. Oil is the dominating factor here, as well as interest rates. So these are key little markets to look at. We have pretty much hit our targets or have hit the levels for support or resistance for most of these currencies. Hey, we do have a question here. Good signals, bro. Thank you very much. How does a 10-year action note move the market? Okay. That's a very good question. So what we're going to do is we're going to pull up a 10-year chart for you. Okay, now remember the futures, because you have to be paying for futures data to watch it in real time. You cannot broadcast in live stream, but we can show you where the 10-year is and where it has ended up. Okay, so as you can see here, this is the 10-year. The 10-year, just like the 30-year, has been trending lower for months here. So if you look at, since 2021 began, the bonds had a huge sell-off, and they had a sell-off already before that. Here we have the 10-year. This is on the weekly. Let's get it to the daily. So as you can see, this is the same thing. We've been selling off since the beginning of the year, and now here we've made a lower move low, and we have made a lower move high. And as you can see, on Friday we were negative. We can go to the CME and show you right now. 10-year is slightly lower at $1.3119, and so that's we're looking at $1.3123 was the close on Friday. So let's put this right here with $1.3120 basically. Okay, so this is where the market is right. Oh, there we got it, 131.19. Okay, so this is where the 10-year is trading right now. It's slightly lower. As you can see, as this market has been trending lower, it does the same thing for the dollar index. Remember how I said currencies have different things that help give you an idea of pricing. One of the major components is the Treasury bonds and the 10-year notes. They're the long and shorter end of the curve. Interest rates dictate part of currency pricing. They also dictate part of commodity pricing, cost of carryover. Interest, think of it like this: as interest rates go up, it doesn't matter what the Fed does, the markets are charging higher rates always. So, and as these start to push up, that causes inflationary issues as well as other things. It also makes currencies more appealing, as other countries are basically at zero rates and buying up their markets. And see, here's the other thing too, is that we still have the long end of the curve. Most of the world functions on short-term interest rates, 1, 2, 5, and 10-year notes. That's it. That's an appetite for destruction on an economic scale over the long run. That's a whole webinar in itself. All you need to know is this: as interest rates go up on a currency, that makes them stronger and more appealing. As they go down, it makes them less appealing. So that's why we have this, we're at a 10-year auction, where a 10-year is at, and things like that, that influences the dollar pricing. Now, 10-year note where it's at right now, if let's say we start to rally up to $133 to 134 to 135 basis points, that would start to weaken the dollar, because as the interest rates go down, remember there's an inverse relationship. As 10-year prices go up, interest rates go down. As 10-year prices go down, interest rates go up. It's an inverse relationship. Wabi-san, nice to see you guys out there. So that's how the 10-year and interest rate equation basically, now this is on a macro level. It doesn't mean that just because today the 10-year note is up, that the US dollar is going to be down versus other currencies. But when you take into account the trend, since the trend here is down and has been excessive, that is where the interest rate level, when the interest rate pricing goes down, the interest rate goes up. As the interest rate goes up, that currency becomes stronger, and that's where those trends correlate, and they can totally help you. You're welcome, man. I hope that was really good to help you with that. It's one of the things that I've been using for over 30 years, and when it comes to, I don't know what indicators you guys use, I always say the best indicators always are the markets. They're always not, they're in real time, and they're forward thinking. All other mathematical indicators are always lagging. So I'm glad that you took on this little tip. And since you're interested in that one, let me show you what I mean with the other currencies, since this will make it really, really jump out at you. So remember, we had the British pound versus the JPY, right? Oops, got too many symbols on there. Okay, so remember we were talking about the oil trade and how that's a very dominant factor. So if Japanese, look at how the British pound here is versus the JPY. Now let's look at the British pound versus the CHF. Same thing. British pound, they make oil. The Swiss don't make oil. That's just a fact. Also, now the interest rate equation, since we're talking about the 30-year and there's no dollar, that doesn't really come into play here. But since the UK is one of the biggest producers of oil, people don't think about it for the most part when you think of England as an oil producer. But guess what? The UK is one of the biggest oil producers in the world. So the cost of oil is indicative. That's like where their rates are at next to zero right now and not moving. Because of oil, that makes their currency so much more valuable, because guess what? You're dealing in both US dollars, British pound, and other currencies when it comes to the exporting of oil. So oil is sold in pounds. If oil is expensive, the pound is also valued higher also. So also, let's look at this. British pound versus the Canadian dollar. Not the same difference. See how it's not rallying against the Canadian dollar and has been in a downtrend? Because Canada produces oil as well. So the oil trade is not so much as influential when it comes to the British pound. So now if you're trading the British pound versus the dollar, this is all key information to know, because it gives you an idea of where strength lies on a currency basis. Just like if you look at the British pound versus the Australian dollar, it's a little bit strong and has been trending higher, but it's nothing really radical, and that's because they also produce oil. Obviously, the UK produces more than they do. That's probably why the rally has been existing as long as it has here. But overall, that isn't the biggest factor. You see it when you, once again, when you go against a currency that doesn't have any type of oil, like the British pound, JPY. Okay, this is where you see the severe trends. The Japanese are an island, and they don't have any oil production at all. It's not to pick on them, it's a fact. Not every country in this world produces oil. But then we go back to the British pound, US dollar. Oil was driving up this thing while we were cutting production, especially. You got to remember, once January occurred into February with the new executive orders, crude oil rallied extremely strong. Now, crude should be somewhat as a net neutral thing for the US dollar, but not when we're restricting production here, and they're also pulling out, British Petroleum pulled out of the United States 100% on any future drillings and projects, because any permits that are in place they can still capitalize on, since there are no longer any new drilling permits or rights ever in the United States again, unless it's turned over by executive order or by legislation. We now have a monopoly going on with the people who are drilling oil. Like, you can't get into it anymore. If you want to go and buy some land and get some permits, if you buy some land and you know there's oil there and there's not a permit already existing that was already applied for and confirmed, you will never get that again. There's no more new drilling. But British pound, they can still keep on drilling. So that's why, since we've had this little tailback in oil, you can see that we've had this corrective neutral trade. If oil breaks out to the upside, boom, we'll see a big rally here. And also the opposite is to the downside. So as you watch our videos, I always get into these, and especially when you bring in correlation questions, because it helps to educate you, and it also makes things stick out a little clearer. I hope that it's beneficial in your trading and that you can help integrate it into whatever you're systems are and the things that you use. We do have some trading signals that are coming up, some high probable Japanese candlestick patterns to watch out for, especially with the gold market and a couple other currencies today. So we'll wait till the close. Since there's no more questions on the chat, we're going to wind down this little webinar. Just remember to always check us out at forex-trading-unlocked.com, and if you haven't done so already, please subscribe to our YouTube channel and hit the little notification buzzer so you know when our next webinar is coming out, and also pass it on to your friends. And if you haven't read the book High Probable Japanese Candlestick Patterns, it's available on Amazon.com in paperback and Kindle versions, and we can show you. Oh, you got another question, Wabi-san. Okay, let's see. So GBP AUD is be aware of oil prices. Absolutely, you got it, my friend. For the pound, for when it comes to oil, the key markets to watch are the pound and Australian dollar, because they produce oil. US dollar does too. So depending on what, so that's why the US dollar yen were strong. If oil is weak, British pound and Australian dollar typically will sell off. Canadian dollar, the same thing as well. They are an oil producer. So now when you go oil versus oil, like pound Canada or Australian dollar Canada, that becomes a little neutral. You have to use other variables. But when you have extremes where you know that a country does not produce oil and they are only an oil consumer and buyer, then when you go against something like the US dollar, the pound, the Australian dollar, oil will be an indicator. So absolutely be aware of oil prices for sure. And especially, let's go back, I'll give you one more look at something since we got this question on here. So let's go back to the CL1. Once again with the crude oil. As we can see how this trend has been over the past couple months, I have a target of $100 oil probably by the fall or the end of the year. We may hit it by summertime, especially if we start to see a big explosion. If it happens fast, that we get up to $70, $75. And if we have currency confirmation as well, that will definitely help to drive these trends. So you'll be able to get on with a very low risk trade in currencies like buying the US dollar yen and getting an excessive rally that you normally wouldn't have because you're riding the crude oil trade. So this is a way where you can actually trade crude oil, but you do it through the currencies, you know. So sorry about the lawn crew out there. They're kicking up. Let me shut the window. It's not going to totally quiet it down, but the guys are out there with the mowers and the blowers already. So let's see. UKoil is a good way to track the GBP. UK oil absolutely is a great way to track the British pound. You got it, Wabi-san. So thank you for your questions and your interactions. And hey, on the videos too, you can always leave some comments. We do answer them. So if there's something that we didn't cover today in this video that you have a question on, always leave comments on our videos. We check them out and we will get back to you as soon as possible on those. We really appreciate that interaction. And once again, I'm Teddy Keckstedt from Forex Trading Unlocked. And please check us out again soon. And we will, after today, get those signals out to you either this evening or tomorrow morning. And we will be checking out what's going on in the Forex market. Right now, there's really no trade to go participate in. So never try and force a trade. Wait for a signal to happen. Have your trading plan in place. And then you execute it and you ride the wave. So have a good trading day. Oh, you're welcome, man. To Ruben Boss. Sure, man. Thanks a lot. We